what an IPO is and how you can invest in IPOs. Check it out. Hi everyone, my name is Francesco Fantecchi, and today I want to be talking about IPOs, initial public offerings, what they are, how they are structured, what are the different components and parties that agree to an initial public offering, and how you can invest in IPOs. Thanks to an ETF that was built by a very specific company. So an initial public offering is when a company goes to a bank and asks to be quoted on the stock market. So basically an IPO is a moment in which a company from private becomes public, and not only private and sophisticated investors can now invest into the company, but there are plenty of different investors all around the world that can basically invest in this company. So basically an IPO is generally done because a company wants to gain a larger audience, it wants to gain a certain respect from the institutions, and it definitely wants to become more famous, it wants to scale. So there are a lot of different reasons actually that bring a company to become public from private, but the reason the main reason for becoming a public company is because very often companies in the early stages need more capital to undergo new investments, and therefore they want to gain a larger investing audience in order to get this money and undergo these projects and investments. Particularly speaking, generally it's tech companies, biotechnology companies, and generally speaking, these unicorns companies are defined by large audiences in the US, are these companies that are involved in the technological space, and for this reason they need large investments in order to make a lot of money, a lot of cash flow. The companies that generally help start up and tech companies in general to become quoted stocks on the stock market are investment banks. Investment banks generally include Goldman Sachs, JP Morgan, Morgan Stanley, they can include Chase, they can include Wells Fargo, they can include T. Rowe, they can include Blackstone, BlackRock, and so on. So there are a lot of investment banks in the US that help startup and tech companies to become quoted on the stock market. And of course, they gain a commission to do that. So Goldman's, let's imagine that we have Airbnb who wants to become a public company from private. It goes to Goldman Sachs and it says, we want to become public. What Goldman Sachs does is that they gather a lot of documentation that it's needed for the SEC, the Securities and Exchange Commission, to become public. They work with a lot of different lawyers and attorneys, both from the startup side and the investment bank side, and they give this documentation to the SEC. And after a certain period of time, the company is in a pre-IPO, which is the moment in which investors can start purchasing at certain prices thanks to certain brokers the stock of these companies. And then the day that the IPO actually becomes real, the company actually goes public, it's when it's available to all investors around the world. And generally speaking, an IPO is a moment in which there is a lot of hype for a company that is becoming public. So the price of this company generally goes up very rapidly in price, but it then gets back to where it started trading at the beginning of the day. So we generally have a sort of patterns in IPOs in which we have a bull run in the very first hours of the quotation, and then we have a sort of the bursting and deleveraging of the price that generally gets back to the moment in which it started trading, and from there it generally keeps going lower and lower in the first 6 months. We also have to notice that when a company goes public and it has an IPO, there are a lot of private investors and employees of the company who want to get rid of their shares because they have increased a lot in price since their inception, and therefore they definitely want to cash out those investments to the public. So generally speaking, the components of the company, the people who are intern to the company, and they have a lot of different shares and call options on the stock of the company. Generally, they have to wait a certain period of time before being able to actually sell those shares to the public. And generally, this period is around 6 months. So generally speaking, we see a lot of selling pressure from the first days of IPO, and this selling pressure generally terminates around 6 to 9 months from the inception of the company, because all the insiders have already sold the shares that they wanted to sell in the public market from the first 6 to 9 months. And therefore an IPO generally has a very specific pattern in which it goes very high in the first hours of trading, and then it generally goes down for around 6 to 9 months. And this is exactly the right moment to purchase an IPO for the long term. So let's imagine Facebook. We know that there was a lot of hype, and the stock price went up in the very first day of trading, but then it went down almost 80% from its initial price. And then we all know that it had a great bull market from there on. So this is generally something that we have to take into consideration when we invest in specific IPOs. Generally speaking, there is also an ETF that was built by Renaissance that it basically includes a lot of different companies that went public in their first year. After the first year, generally these shares are unloaded by the fund, and the fund purchases other shares of other companies that are going public. And today, in addition to going through all the different characteristics of what an initial public offering is and how it works with the investment banks, as we have already did, and what is the recurring patterns that we see from a trading perspective, I wanted to go through this specific exchange traded fund. And in order to do so, I'm going to share the screen with you here. So basically, an exchange traded fund is, basically a financial instruments that gather a lot of different, securities of the same kind. As we can see from here, the Renaissance IPO ETF is an ETF that has a market price of $30, more or less, and it has, of course, a yield of 0%, because we know that generally speaking, IPOs never really give out their dividends. So because they want to, they have gone to the public markets in order to gather capital in order to make investments. So they don't want to really give out their cash flow to investors, because they think that, generally speaking, the company and the shareholders can have a further appreciation by just keeping and holding the money that they make onto the business and reinvesting onto the business, instead of giving it away to shareholders, or repurchase their shares. So basically, IPO companies think that they can create more value just by reinvesting in the company instead of giving out their money. So we can see from here that basically we have a majority of stocks in this ETF, which is technology. It's at around 52.5%. And then we have all the other companies that are in this index are consumer discretionary, 12.7%, healthcare 12.2%, financial 7.8%, consumer services 7%, industrial 3.2%, real estate 2.6%, and consumer staples 1.8%. As we can see from here, the sectors that are generally included the most in these IPO ETFs are the most advanced sectors, which are in this case, of course, technology and consumer discretionary and healthcare. So we generally have very important and new biotechnological companies. We have a lot in the technology software space. We have a lot like in the security. We have a lot in many different branches that are very new and are related to advancement in technology, and therefore the need for a lot of capital from investors. As we can see from here, the top 10 holdings are all companies that everybody is familiar of if they are interested in the stock market, and these are Airbnb, which has a weight of 8%, and then we have Snowflake, the Berkshire Hathaway participation on this software as a service company. We have Datadog, which is a company that basically gathers a lot of different data and basically structures software on the basis of that data. We have Li Auto and Xpeng, which are basically cars company. We have Palantir, which is a company that is involved in the construction of software that are related to security, especially like for the government. Palantir is a lot deep onto like helping the FBI and other federal agencies to get criminals and helping them leveraging the United States technology for security and law purposes. We have DoorDash, which is of course a food provider company, which basically links demand and supply by going to different houses of consumers and bringing them the food that they have ordered. We have Royalty Pharma, which is a very famous and important biotechnological company that is developing right now. We had Cloudflare, which is a company that is engaged in cloud services. And finally, we have BioNTech, which is specifically a vaccine company that was born in response to the COVID-19 crisis that we had in 2020, and it didn't have a very good performance given the fact that there were other two important companies like Pfizer and Moderna who were mostly engaged with the production and commercialization of the vaccine. So let's go ahead and let's open a graph to see how the IPO ETF has yielded so far in its history. We know that it's an ETF that, as we have seen, it has a lot of very good companies. So we can say that this fund is really able in choosing the companies that belong to this ETF. And in fact, in my opinion, is one, if not the most important and most, if we can say, recognized ETF in the IPO space. So as we can see from here, IPO is an ETF that has a pretty similar behavior with respect to the ARK investing fund, because of course both these companies and these funds invest in high growth, high risk companies, as IPOs generally are. And as we can see from here, we can also make some inquiries and some suggestions about how an IPO ETF behaves on the basis of the market cycle. So we know that when there is a crisis, there is a very strong recession, and basically central banks around the world have to inject a lot of liquidity in the market. So what happens is that there are a lot of companies who take advantage of low interest rates in order to go public. So we have a lot of companies that actually go public and have their initial public offerings at the beginning of a market cycle. So when interest rates are very low, because they want to get a lot of money from the market and do it at a cheap price. So the best companies that go public are in this first segment, in this first branch of the economic cycle. And in fact, we can see from here that when there is a lot of liquidity, interest rates are low, there is a lot of optimism for the technological space as a whole. The Renaissance IPO ETF goes higher and has basically a very important market rally. In fact, we can see from here that from March 2020 up until basically February 2021, we had a one-year bull market that almost quadrupled the ETF here. Then when we are at later stage of the business and economic cycle, we have companies that were not really able to get into the market at low interest rates due to the fact that maybe there were some regulatory issues, the business was not ready, and basically they didn't have enough cash flow, and so the investment banks didn't want to go them public because they were already making a lot of money with great companies that were going public. So the investment banks started thinking about the fact that their commissions are going lower. And if their commissions are going lower for these deals, they want to have more deals in order to retain their high commission. So what they do is they basically easen all the credit issues related to making a company public, and they bring to the markets a lot of companies that actually aren't doing as great, which have negative cash flow. They can have also negative equity in some instances, and therefore they bring to the public a lot of companies that aren't really worth and aren't really making money. So and moreover, what it happens is that these companies finance themselves with high interest rates because they are worse companies, so banks are going to give them higher interest rates. And at the same time, we are at a later stage of the business cycle, which means, of course, that the interest rates are higher, and therefore these companies can and generally have worse terms for their financing and, generally speaking, for their initial public offerings. So from here, we can see, in fact, that from the second half of the business cycle, which is from February 2021 ahead, we had a very strong bear market that basically has brought again these ETF to pre-pandemic levels at around $31.78 per share. In my opinion, this is, of course, a moment in which the ETF is still very weak, and it can have a little bit more of drawdown given the fact that we are not sure about where interest rates are going. But of course, if there is a recession in the US and the yield curve basically becomes inverted, and these companies have lower discount rates in the future, we can expect that these companies are going higher. So it's a little bit counterintuitive here what it happens when there is a recession for technological stocks. So we know that technological stocks generally have stable business models. I mean, they have a certain market niche, and this market niche, we can say, is pretty stable over time, and it doesn't suffer a lot from economic cycle. So for example, let's take Airbnb as an example. Airbnb is a company that, yes, of course, is a consumer cyclical company, so it can suffer a little bit from the economic cycle. But generally speaking, we know that even if it has a little bit of lower volumes, it still retains its margins long term. So even if there is a sort of drawdown in the economy, Airbnb is pretty capable of maintaining its business model to good levels, because it has a business model that, generally speaking, it works, even if they have been cash flowing negative for the past years. But at the same time, what happens from a evaluation perspective is that long interest rates, when there is a recession, long interest rates go down. And being these companies very sensitive to interest rates with a lot of duration, in fact, this company have high sensitivity to long-term interest rates, and therefore we say that they have high duration, their stock prices is supposed to go up in recessionary terms, because basically the cash flow that is expected in the future is discounted at a lower rate. So even if the investors can price a short-term suffering, the fact that long-term interest rates go down, it brings up evaluation. So basically, in recessionary periods, these companies can really achieve great returns, because the Federal Reserve basically bring down interest rates and inject liquidity in the market. So generally speaking, I think that this ETF is a good investment at this point. I would really invest in companies that can make the history of the next 10 years. And of course, on Airbnb, Snowflake, Datadog, BioNTech, and all these companies that we have just seen, Liauto, and so on, Xpeng, they can really change the future of our world. Of course, we have to say that Xpeng and Liauto are not Tesla, but that said, we can still say that they are great companies, and they will definitely have large market shares in the near future. Okay, so I guess this was all for today. We talked a lot about IPOs and how these companies are valued from a business cycle perspective. I really appreciated bringing this topic to the channel, because I think that it's very important for investors to understand what an IPO is and how it can exploit it from a trading perspective. So if you like the video, please smash the thumbs up and comment down here. Also, subscribe to the channel if you like this kind of videos. I'm looking forward to coming tomorrow with a new video about investing, finance, money online, business online, jobs, and so on. So please smash the thumbs up and subscribe to the channel. I'm looking forward to coming tomorrow. Have a great rest of your day.